I, Dr. B. Santhi, Assistant Professor and Head, Department of Cooperation, Vellador College for Women. Today, I would like to discuss about working capital, a key concept in management accounting. In this session, I cover meaning of working capital, importance, types, components, etc. Basic concepts and introduction to working capital. A business concern requires both fixed capital and working capital to run the business smoothly and systematically. Fixed capital is invested on fixed assets such as land, building, machinery, furniture, etc. and used in the business for many years. And working capital is required for investing in regular business operations to purchase raw material, pay wages, etc. Funds invested in current assets keep revolving fast and are constantly converted into cash, and this cash flow out again in exchange for other current assets. Because of its revolving nature, working capital is also called as revolving capital or circulating capital. Working capital is the backbone of day-to-day business operations, and it helps in production, sales, and payment activities. It uses information from the balance sheet and cost-related data from financial accounting and cost accounting. So, financial accounting and cost accounting are the basic foundations of management accounting. Meaning and definition of working capital. Working capital refers to the funds invested in current assets to meet short-term business obligations or operational requirements. Working capital is defined as the difference between current assets and current liabilities. Formula: working capital is equal to current assets minus current liabilities. Few more definitions also given for your reference. Importance of working capital. Working capital ensures smooth business operations and helps a firm to carry out its day-to-day activities such as purchasing of raw material, paying of wages, and meeting routine expenses without any interruption. Working capital maintains liquidity and it enables the business to meet its short-term obligations like creditors, bills payable, and other current liabilities on time. It improves creditworthiness of the business. It means a company with sufficient working capital gains the confidence of suppliers, banks, and creditors, and it helps in obtaining credit easily. It facilitates bulk purchases. With enough working capital, firms can purchase raw materials in bulk and enjoy trade discounts and cost savings. Working capital helps in facing emergencies, to handle unexpected situations such as sudden increase in prices or decline in sales. Working capital increases profitability. Proper management of working capital ensures efficient use of current assets, which ultimately improves profitability. Working capital enhances goodwill. Timely payment to creditors and employees improves the firm's reputation and goodwill in the market. Types of working capital. On the basis of concept, working capital is classified as gross working capital and net working capital. Gross working capital refers to the total investment in current assets of a firm. It focuses only on the asset side and it shows how much money is invested in short-term assets. Net working capital. Net working capital is the excess of current assets over current liabilities. It indicates the liquidity position of the business. If current asset is more than current liabilities, the net working capital is positive and it is good for the firm. If current assets are less than current liabilities, the net working capital is negative and a firm faces some sort of risk to run the business. On the basis of time, working capital is classified as permanent or fixed working capital and temporary or variable working capital. Permanent or fixed working capital refers to the minimum amount of working capital required to run the business continuously. And the temporary or variable working capital refers to the additional working capital required to meet seasonal or special demands. Components of working capital. Components of working capital are divided into two main parts. One is current assets and another one is current liabilities. Current assets are short-term assets that can be converted into cash within 1 year. It includes cash and cash equivalents that are used to undertake daily transactions. Another component is accounts receivables or sundry debtors. It means the amount receivable from customers for credit sales. Inventory or stock. It includes raw materials, work in progress, and finished goods held for sale. Short-term investments or marketable securities. These are the temporary investments that can be easily converted into cash within short period, normally 1 year. Bills receivables. Bills receivables are the written promises from customers to pay a certain amount on a specific date. Prepaid expenses. Prepaid expenses are expenses paid in advance such as insurance, rent, etc. Current liabilities. Current liabilities are short-term obligations payable within 1 year. It includes account payable or sundry creditors. It means the amount payable to suppliers for credit purchases. Bills payable. Bills payable are the written promises made by the firm to pay a certain amount to its suppliers on specific date. Outstanding expenses. These are the expenses due but not yet paid. Example, wages and rent, etc. Short-term loans and bank overdraft are also the current liabilities. They are repayable within a short period, normally 1 year. Factors determining working capital requirement. Working capital requirement is influenced by many factors such as nature and size of business, length of operating cycle, credit policy, growth and expansion of business, seasonal fluctuations, and price level changes. Problems of inadequate working capital. A business with inadequate working capital may face difficulty in meeting its day-to-day expenses such as payment of wages, rent, etc. It can lead to delay in purchasing raw materials which may interrupt the production process and underutilization of production capacity of the firm. The firm may lose its goodwill and reputation due to its inability to pay creditors on time. The business may not be able to take advantage of bulk purchase discounts due to lack of funds within it. The firm may lose profitable business opportunities due to lack of liquidity. Employee morale may decline if salaries and wages are delayed. The overall efficiency and profitability of the business may be adversely affected by the inadequate working capital. Problems of excess working capital. Excess working capital indicates that the funds are kept idle and not being used efficiently in the business. It may lead to unnecessary accumulation of inventory, increasing storage and holding costs. Excess liquidity can reduce the rate of return on investment, lowering overall profitability. Excess working capital may lead to over-generous credit policies, increasing the risk of bad debts. The business may face higher operating costs due to inefficiency and wastages. Shareholders may be dissatisfied due to lower returns on their investments. So, a business firm should maintain optimum level of working capital. With this, I conclude this session. Working capital plays a vital role in business success. The proper management of working capital ensures smooth business operations and avoids liquidity problems, and it improves the financial stability and long-term growth of a business. Thank you.